From one retail investor to another. This is Trader72 back again, second time this week for another analysis. Welcome back, guys. I hope you're having a tremendous week wherever you are. Indeed, it's still quite messy here in the UK. Weather's not good. It's been hot, it's been cold, it's been stormy, it's been windy, and a little bit like the current markets at the moment. But without further ado, let's start our second analysis of the week. And whilst we're in the world of AI, which is the, please do refer back to my last video regarding obviously semiconductors, I felt that it was a good time to stick with it this week for one more in that sector at the moment. I like to move around, I like to do different sectors, but Marvell, which is the one we're looking at today, was also mentioned by Jensen Huang last week, or this week I think it was, about regarding as the next trillion-dollar company. Guess what it did? Well, it went up about 25-30% and made added trillions to, or billions to, its share price just by one man, Mr. Nvidia, saying that this is the one to watch out for. So I thought I'd look into it, and it kind of made it more into another piece of the puzzle within the semiconductor world, which I think is going to be key to the evolution or revolution of AI and going forward. These companies are all in a chain and a puzzle, and they all have a duty within that evolution, that circuit. And Marvell are potentially the final puzzle of the four that I actually analyzed in the previous upload that I did, which please do refer back to my four semiconductors and which one might be the best to invest in, which we already did. And Marvell is potentially part of that final puzzle, final piece of the puzzle. Let's start with the history of the company. I like to understand what the roots of the company are before I start investing in anybody across the board, whether it's even a well-established company that I'm already aware of. It's always good to know its history. History is part of our fabric, understanding where the company starts, where it's, moved on from, and it just gives it a foundation, really, in terms of understanding where the company is about, its DNA. It started back in 95. It was started by a husband and wife, as it says, Sehat Sutaja. I'm going to try not to destroy the name, so apologies if I do. Weli Dai as well, alongside Sehat's brother, Pantas Suthaji, even, should I say. So back in 95, what they did is they started making chips for hard drives for computers to store data. So if you bought your PC or Xbox in that time, there's a very good chance that the actual chip to store the data would have been made by Marvell. So they had clearly already quite a handle in that market. The problem was the mid-2010s, as it says there. Traditional PC market started slowing down, which it did for a while. Smartphones took over the world, and everybody dumped their Xboxes and their PCs at that time, going pretty mad. And of course, Apple as well, the rise of Apple. So basically, the chips Marvell made were becoming cheap commodities with lower profit margins. So the founder eventually stepped down in 2016. It was then taken over by a chap called Matt Murphy, who's really was the great, as it says there, the great pivot of Marvell, and where he changed from 16 to 21. So he realized the company obviously was selling cheap chips, wasn't working, didn't make the money, wasn't the future. So he basically started looking at the bigger picture here. And Marvell spent millions of dollars buying specialized tech companies. The most important purchase was a company called IMFI in 2021. IMFI was the absolute leader in electro-optics, the tech that uses lasers to move data at lightning speed, which is a key point to what Marvell will be going. And I will explain again a bit more simply for some of you that may not know, or not be like me, not very AI savvy, or I am becoming since I've started doing more research for the show, where the key point of where that sits and what does it actually mean within making those chips. So because of the AI infrastructure leader, it became obviously, Marvell completely transformed. They went from legacy PC storage company to one of the most vital gatekeepers of the AI revolution. So that kind of was the turning point there, really, in 1621, by buying this IMFI company that bought this electro-optics. And that was the turnaround of really the first three acts of Marvell and how it turned from what it was. So I like to kind of simplify things in my head, and sometimes I like to use examples which will make sense to me. Now, most of you might be very tech savvy and look at this and go, "Well, we understand what it does." You're treating us like, like we don't know. And some of you may actually have an idea, like I did. So I'm going to simplify what actually Marvell does, which is going to be, an analysis in terms into a scenario of how you can understand what the business does. And I'm going to change it into what we call the highway analogy here, how to explain how Marvell simply works. So to understand Marvell as a company, it's basically, imagine an artificial AI and internet as a massive bustling city. So it's basically Nvidia AMD basically build the sports cars, they build the fast processors, the GPUs to do the basically the heavy lifting. So Marvell doesn't have any, like ASML, I suppose, or even like TSMC, which obviously is the manufacturing of the company. They don't have anything to do with the design or the actual lithography, which ASML do as well. And again, Marvell, the reason why I do Marvell is because they sit alone in what they actually do. So Marvell basically builds the high-speed expressway traffic lights and hyperloops that connect everything. So all the connection between ASML to AMD, all this has to be funneled through, and specifically is an expert in the data center. So, as an analogy, again, just to kind of simplify, if the roads are cracked and narrow, it doesn't matter how fast the sports car goes, traffic will grind to a halt. Marvell makes sure the data moves between chips at lightning speed without getting stuck in traffic jam. So that kind of makes it trend. So what they have is this translator optical chip. So the three things that Marvell actually does. So computer inside a data center talks to each other using electricity. But electricity is too slow when moving data across a massive warehouse. So the amount of information going through to the data center is humongous. It's too slow. So Marvell makes chips that instantly translate electricity into light laser and sends it down fiber optic cables. Light travels much faster, eliminating lags. Big giants like Google, Amazon, and Microsoft don't always want to buy the same off the shelf the chips, so they want their self-made chips. They want it for their style, their company. Exactly what you need, what data centers to do. You can design a custom chips just for us. Marvell designs it, gives it those tech giants a massive efficiency boost. So basically, Marvell is the traffic controller. It's from the data centers to the cloud and everything else. It basically speeds up everything through these fiber optics cables. So this is, bear with me guys, it's not always that easy to understand, but it gives you a bit of an analogy that effectively they are the builders of the road, the builders of the traffic lights, to make sure that the process of the data goes faster and bigger throughout the system effectively. Now, whether it's a 5G cell tower, a smart car, or a corporate office, a lot of data is flying around at once. Marvell makes the digital traffic cops, routers and switches to make sure that data gets to the right device safely and instantly. So that's even from a personal point of view. From a 5G, when you're moving your 5G data across, that they make sure that that goes through the right path in the right optics. So that is what Marvell does. Please do let me know if that doesn't make sense. I can always kind of re-go through it at some stage, or any comments below. So we're now going to stage 3, where I've got to know about the history of the company. I understand what the company does in terms of meaning, and the next step really is to understand where the revenue comes from. How do they actually make their money, and how do they do it? So we've established that effectively they sell optical laser chips that connect AI computers together. That's basically what Marvell do, as opposed to TSMC, who basically manufactures the actual chips for the AI. So all this is interconnected by Marvell. They are the masters of the actual highway, as I gave an example. Now, how do they make their money? So effectively, there's 4 different stages there. 4 side hustles. They've got the enterprise networking, which is selling the chips to Wi-Fi routers. Their carrier infrastructure. They sell chips to telecom companies like Verizon and T-Mobile. They're automotive and industrial. They sell high-speed internet chips built inside modern cars, and also they cater to the consumer, which is their oldest and smallest business, which are the basic chips used in hard drive, which obviously was their initial historical business. There are basically, out of the revenue, 75% of their revenue is through obviously the power of enterprise networking, which is for data centers. So we all know that all the big sevens are now buying the Microsoft of this world are buying huge amount of data centers to store the information for AI. And that is, of course, the connectivity has to move around. And again, Marvell is very much heavily involved in data centers. So that's 75% of their business is through data center. So as you said, their viewers, if you want to know whether Marvell gets money, look no further than the cloud, basically. Roughly 75% of their entire business is purely supplying giant AI data centers. The rest of their money comes from smaller techs like 5G cell towers, smart cars, car brains, and office routers. But really, the main business here comes from AI data center built. So that's kind of gives you an idea again of the percentage of the revenue and where the biggest chunk of the business is in terms of reliability for that business. It's quite a large chunk. There are companies that maybe would have a bit more of a variety, but still at the end of the day, the rest of the business like carrier infrastructure, industrial will eventually grow as well. So I presume that will be a bit more equilibrium within the revenue. So now we're going to go to the 4 M's: the meaning, the moat, the management, and the margin of safety. Now, the margin of safety, we're going to ignore that for now because that will be done through my DCF model, which obviously I go through every time we do an analysis. So we're going to go for the top 3, which for me is a very important criteria before I invest in a company. And this comes from the 4 M's, which is Paul Towns, not rule number 1. I've incorporated, this is the idea that obviously as an investor, as you get along, as you get more experience, you incorporate the best bits that you think suit your best trading style. And that's really important to have, I think, at this moment in time. So 4 M's for me was a real wake-up call in terms of even value investing, in terms of long-term investing or short-term investing, where at least when you buy into a company, you know what you're getting. You understand the story. You understand the basis of the stock. And that's really important because sometimes buying a stock at a good stock at the wrong price can be a disaster, as we well know. So you've got to make sure that the first bit you need to lock down is understanding the meaning, the moat, and the management. Now, the meaning is a pass because obviously it's got a huge network effect here. And Marvell, thanks to the high-speed highway analogy, the concept of Marvell is simple to understand. They make the connectivity and infrastructure for AI. However, because semiconductors are deeply technical, keeping up with their product updates requires some homework. So obviously that does need to obviously be constant investment. But it's safe to assume that they are the only one within that market that are handling that connectivity. So that does give him a meaning. Moat. Well, of course, the company must have a clear competition advantage that stops rivals from stealing its profits. Marvell is a formidable switch cost, intangible asset moat. Their electro-optics and custom AI chips design are deeply integrated into the data center blueprint of cloud giants like Amazon and Microsoft. So again, irreplaceable business, and probably the only one at the moment that have the capabilities to actually install that skill set within the puzzle of the AI evolution. So I think from that point of view, it's safe to assume that they are pretty strong in their moat. They are the dominant player in that market, meaning by moat, which obviously is what surrounds a castle, the defense. And obviously if the defense has been invaded or eaten into or disappearing, obviously that is a big question mark about why. But at this moment in time, it definitely qualifies on the moat. So the management obviously is very trusted. It's a pass all day long. Matt Murphy's been around since 2016. There's been a major turnaround of the company, and it basically is positioned Marvell into the AI evolution from just doing PC chips back in the early 2000s. So definitely somebody that understands the business and will probably propel the business going forward for sure. So the big pass there. We'll come to the margin of safety, as I said, later on for now, but that is definitely all ticks for all 3. So the balance sheet now, guys, in terms of Marvell. Let's dig into the numbers now because this is obviously a very important process. I'm giving you a rough idea because obviously I spend a lot more time looking at numbers than just going through it for a period of time. But for argument's sake, in terms of the time we have, let's look at the most highlighted numbers that we look for. So the first thing we do is, as you guys know, this process I go through, is look at the market cap versus the enterprise value. Now, the difference between these two means that obviously the debt of the company. So currently at the moment, 83 versus 86. So there's about a $3 billion debt going on there, which, you know, if you're looking at their free cash flow, is pretty minimal. Now, the debt needs to be repaid pretty quickly if there's any issues, and that's what you look at, debt versus equity. In this instance, really, if you're looking at the free cash flow, which is the cash that's left pretty much after every expense is been done and dusted, it looks like pretty safe. The fact that I think they will pay their debt pretty damn quick. As long as they do it within a period of 3 years, that's pretty good. And at 1.3 billion at the moment, trailing free cash flow from actually literally 0.89 to 1.3 billion, it's pretty safe to assume that they can pay their debt back pretty quickly. So no issues there. The price to free cash flow, which is, you know, anything above 20 or 2030 is very expensive. That's 63 times free cash flow, which is very, very high. But let's take in context, this is a tech company, AI tech company, on the up, making a tremendous amount of cash. So at the moment, that is forgivable, although obviously, when it reaches a plateau, we expect that to come down by quite a bit. But it does make it quite expensive, going from 44 times earnings the last 5 years to 63. So that is quite high. Average net income is obviously 0.47. Now, we like the free cash flow to be above that, because obviously net income can be fudged by accountants as we go. And it's amazing the amount of people that just look at the net income before the free cash flow, which I think is a big mistake. The free cash flow is, you can't lie, it can't be fudged. It is what's left after all operations have been deducted. So this is the money that they'll be using to invest, to pay dividends, etc., for expansions as well, capex as well. So this is, or even buybacks, which obviously we do like if the share price is cheap enough to take some shares off the market. So important. Now, the P ratio does fluctuate, but it is at 91 times earnings, which is pretty in the ballpark. It's quite very expensive. I mean, there's no doubt about it that 91 times earnings for me is slightly outside the ballpark of what I would normally invest into an established company. But it has gone from 77 to 91 because of their success, obviously. The PEG is quite high at 1.8, which is a little bit above the one that you would expect. That means that the share price is quite expensive at that, based on the PEG, which is quite an old-fashioned matrix to count, but it does actually go in with PE ratio and the DCF model, so it kind of backs up a little bit what we think. Profit margin has gone from 10.8 to 16.5 in the last 4 years, so really outstanding numbers again. Gross margin is at 63%, so for every dollar they spend, they get 63% back. For every $6 they make, they get 63%. They keep 63% and a half for themselves, which is again another staggering amount, really. Maybe not as good as Nvidia as yesterday, which I did a analysis which I think was 97. So at 63, still very impressive there. Revenue, fun enough, has suffered slightly in the last few years. We'll have to probably look into that, but still very impressive at 18.7%. Currently, the 52-week high is at 52-week high. We'll come back to that in a minute. That's not quite right there, the number. And their forward PE is at 58. So that gives you again a very there's obviously no dividends to be paid as well, which means that no money's being paid out of the free cash flow on that, which is probably quite good. One other big number that big incentive that I look at for is the ROIC, the return investment and return on investment, which is quite important. Anything above 10 is good. So 12.8, which seems quite small. We'll probably have to double check that number. But over the last 5 years, it was under 10, and now it's at 12.8. So again, amazing. There has been quite a lot of acquisition, £11 billion worth of acquisition over the last 5 years, which is quite a lot. So maybe, again, worth looking at in terms of what they've invested in. Again, the numbers make sense. They all kind of stack up for me, as all of these AI companies do in terms of percentage and revenue and profit, and again, free cash flow. So for me, that is another tick for Marvell in terms of their numbers. But we are now going to the next stage, which is the DCF model. So Now, this is where it becomes a little bit more tricky in terms of evaluation for these companies. And this is something I've encountered for all of the 4 or 5 last AI companies that I've actually done an analysis on. And it is what it is at the moment. It is well overvalued. And it's, again, down to potentially word of mouth by the Nvidia CEO, obviously saying that the company will be what it will be, $1 trillion company in the next 2 or 3 years, or whatever he said at that time, and it boosts the share price. So it's all about speculation, which is crazy, really, if you think about it, because the market is about speculation, but it shouldn't really be to that extent. Now, let's put the numbers in the mix for my DCF model, which is again based on a 10-year model. I don't think I need to re-explain this. I've done it every time. We're talking about the growth of the company for the next 10 years with a discount of 8%, terminal rate of 3% beyond the 10 years, and that with obviously shares outstanding, total debt, and present value. Once you put it all in the mix, now 18% I think is actually quite reasonable, considering that we're looking at 25% plus in terms of revenue for the past 5 years, or even more than that. I think that if you pull it back slightly to slightly more conservative, I mean, you could go above that, of course, a conservative number. I think 18% is about right, as it of all these companies eventually will plateau. Now, the free cash flow, as you can see, is moving up year by year for the last since 2016. So there's definitely a step up there in terms of no worries in terms of the free cash flow at this moment. So I think 18% is quite reasonable, which gives us basically an intrinsic value price of $100. Now, again, this is based on only my assumption of 18%. You can up that if you guys feel that the company is going to earn more, which will probably make it maybe 120, 130, but still at the current price of $306 a share, it is valued by well over the margin of safety that I would even consider buying into. We all know that my margin of safety is 25% off its intrinsic price, undervalued, and at this moment it's calculated at almost 200%. So it is a staggering amount, probably the most overvalued company I've done so far. Now, again, this is based on my own assumptions. Please don't do your own homework. I will say that I'm not a financial advisor. I'm here just as an advisory, and this is my own system that I've adopted. So you guys may well differ. You may want to do a different type of DCF model. There's several DCF, on the EPS level. I do it on free cash flow, which doesn't lie, and I think for me that's the best system for me anyway at this stage. So that's where we are looking at. So it looks well overvalued for me based on the DCF model. Final thoughts on this company. Now we've ticked the history, we've ticked what the meaning, we've ticked the moats, we've ticked the fundamentals, all in place, looking good. Certainly will be a dominant play for the next 10 years. I'm pretty sure Marvell will be around with the evolution of AI and where it stands in its own right. Critical enabler for AI, high-speed networking solutions, power data centers, which I think are going to be a key point, the data centers, for everybody going forward, and they will be heavily involved in that. Deep customer relationship with hyperscalers, wide moat, technology scale, strong fundamentals. We've ticked all that. It's an A+ company from that point of view. Where the issue is for me is the $100 intrinsic price. Now, even if it's not quite $100 and you want to up it, it still will be well overvalued. Big issue for me will be effectively the 200% premium on the share price. $100 a share, $100 intrinsic price is well over the 306. It would mean basically the company would need to go to make 33% CAGR for the next 10 years, which is unrealistic as an investor that's been around. I don't think that anybody can sustain this unless they have this crazy 10 years. So that does put a lot of pressure on this intrinsic price and the actual share price itself, that it would require 33% CAGR for the next 10 years to actually grow. You are buying an unadulterated FOMO. Now, FOMO means fear of missing out, which a lot of retail investors, including me in the past, have done. You feel like you're left out. You feel you've been left at the station. The train's gone without you. You'll run after the train. You jump on the bandwagon, and suddenly the train stops, and you are at the back of the herd. So this is where I think this is very, very, very dangerous to jump on the bandwagon at this stage and potentially buy in at even this share price there. Now, like I said, great company, fantastic, but discipline at this stage would be what I would advise. This is, again, only my advice. At this moment in time, it is a cracking company. It certainly is, again, one of a kind in terms of, very much like the Visa and the MasterCard, obviously more established companies, but they have that domination in their own market, and I think Marvell is part of that puzzle. But for me, at the moment, it's overvalued and definitely on my watch list. I think $100 would obviously be unrealistic, whether they will ever fall back towards that. I think that if you are looking at anything less than 200, I would put it between 150 and 200 to be a bit more realistic. But even that, for me, would be overvalued. So for me, it's a no at this stage. It's got zero margin of safety, and it's definitely at the wrong price. So wait for the right value, guys, because buying a great company at the wrong price can be a disaster. So this is where my final thoughts are, guys. Let me know if you agree with me or not. Like I said, it's just advisory. I'm here just to kind of give you my knowledge and advice experience for the last 10 years as a retail investor. I have made that mistake of buying into companies like this in the past. I'm not saying that you shouldn't buy in it, but I would certainly look into it more in terms of evaluation, which I think would be the right thing to do. I'm sure the share price will probably go up even more. I think there's also the issue that people tend to be speculative, which I think is also very dangerous with a very, very high market. The semiconductors are running the market at the moment, even above the Mag 7. And I think at some stage there will be a retracement. And I think this is where the opportunity maybe will be for these companies to buy it back in at a more reasonable price, which is whether it's ASML or AMD or even TSMC, which I would say would be the best of the bunch in terms of investing. But even at that point, I think, or Nvidia, which actually is slightly compressed. But again, we're not talking about those companies. We're talking about Marvell today. And again, I think very similar issues that we're finding in terms of everything is great. The business is fantastic, but the share price does not make sense. That's my opinion. So, like I said, make comments below. Please make your comments. Leave anything that you believe or not, I'm right or not in this instance. Be great to hear from you guys. Big news from my point of view. There's been quite active. Obviously, I've now got on a long-term basis, I'm keeping Netflix on my portfolio, and I still think Netflix is a great company. I might have bought it slightly at the wrong price initially. It has fallen back, and of course, no major changes with Adobe. In terms of more short-term, in and out stocks, I bought into Meta yesterday at 600, sold it at 612, made quite a bit of profit there. Nice little tiny profit. Like I said, it's never huge amounts because obviously I'm not playing with a huge amount at this stage, and I'm also being very aware of my account value, which obviously you've got to take care of. You can't overspend silly billy money, so you've got to be aware of that. Now, of course, I've got another account which is slightly bigger, so this is more for Trader 72, and obviously sold Meta at a good price there, and I bought back into Uber and also S&P Global. Sold S&P Global at 415 this morning, bought it at 409. So I've got a nice little strategy going on at the moment, buying on the support line, just kind of, really looking at where the share price falls back and buying on repeat really at the moment. And S&P Global enabled me to do that this morning, so I backed a little bit of profit this morning on S&P Global. Uber is actually up as well this morning at 72. I bought Uber yesterday at a really good price, 70.5, and it bounced off that low. So yeah, looking pretty good. I've had a pretty good cleared quite a good week, over £500-600 in profit. So far good. Not too bad for just going in and out of stocks. I will be splitting the portfolio in two halves, where I would use some money for more short-term to mid-term buys, so it could be a couple of days or a week, 2 weeks, and then keeping maybe cash for maybe one or two companies on a long-term basis. So that's the strategy behind my portfolio. Guys, please make comments below on what you think. Subscribe and smash the like button if you can. That would be much appreciated. And I will leave you guys on this very wet, stormy day here in the UK at the moment. From one retail investor to another, this is Trader72 signing off. Take